Hi everyone! Welcome to Money is Money. Today, we're diving into the world of investing for beginners. Investing is a powerful tool for building wealth over time, but it can seem intimidating if you're just starting out. Don't worry, we'll break it down step by step so you can begin your investing journey with confidence. Whether you're saving for retirement, a new home, or financial freedom, understanding the basics of investing is crucial. Let's explore how you can get started. First, let's delve into the basics of investing. Investing involves putting your money into various financial instruments with the goal of generating returns over time. Stocks, for example, represent ownership in a company and can offer growth potential but also come with risks. Bonds, on the other hand, are debt securities issued by governments or corporations, providing regular interest payments and a fixed maturity date. Mutual funds are another popular option for beginners. These funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. This diversification helps spread risk and can be a more conservative approach for those starting out. Understanding these basics is crucial as they form the foundation of your investment knowledge. Now, let's explore how to get started with selecting investments that align with your financial goals and risk tolerance. Before you start investing, it's crucial to define your financial goals with clarity and specificity. Your goals act as the guiding force behind your investment decisions, shaping your strategy and determining your timeline for achieving financial milestones. Begin by asking yourself, what do I want to achieve financially? Are you saving for retirement, aiming to purchase a home, or perhaps funding a child's education? Each goal will have its own financial requirements and time horizon, influencing how you allocate your investments. Setting clear goals helps you prioritize where to allocate your resources and how much risk you're willing to take. For example, short-term goals like building an emergency fund might call for safer, more liquid investments, while long-term goals such as retirement savings could accommodate more growth-oriented investments. By defining your goals early on, you empower yourself to make informed decisions that align with your financial aspirations. Later, we'll explore how to select investments that match your goals and risk tolerance effectively. Understanding your risk tolerance is crucial when it comes to investing. Risk and potential returns are interconnected in the world of investments. Assessing how much risk you're comfortable with is a pivotal step. Younger investors often have a longer investment horizon and may tolerate higher levels of risk. They can consider more volatile investments like stocks, historically known for higher long-term returns despite short-term fluctuations. On the other hand, investors nearing retirement or with shorter-term financial goals may prefer more stable, less volatile investments such as bonds or diversified mutual funds. These assets typically offer steadier income streams and are less susceptible to large value swings. It's important to note that your risk tolerance may evolve over time with changing personal circumstances. Choose investments that allow you to sleep soundly at night and remain calm during market volatility. Next, we'll explore how to select investments that align with your risk profile and help you achieve your financial goals. Next, choose the right investment vehicles based on your goals and risk tolerance. Stocks represent ownership in a company and are known for their potential to provide higher returns over the long term. However, they can also experience significant price fluctuations in the short term. Bonds are debt securities issued by governments or corporations. They are generally considered less risky than stocks and provide regular interest payments, coupon payments, to investors. Bonds are often sought after for their stability and income generation. For a diversified approach, consider mutual funds or exchange-traded funds (ETFs), known as Findex funds. These funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are actively managed by fund managers who aim to outperform the market, while ETFs typically aim to mirror the performance of a specific index. Choosing the right mix of investments depends on your investment objectives, time horizon, and risk tolerance. Diversification across different asset classes can help manage risk while potentially maximizing returns. In the next step, we'll delve into how to construct a balanced investment portfolio tailored to your financial goals and risk profile. Diversification is key to managing risk. Spread your investments across different asset classes, industries, and geographic regions. This helps reduce the impact of market fluctuations on your portfolio. For example, consider allocating your investments into stocks, bonds, and real estate. Stocks offer growth potential but can be volatile. Bonds provide stability with regular interest payments. Real estate can offer income through rental properties or potential appreciation. By diversifying, you can potentially maximize returns while minimizing risk. It's important to regularly review and rebalance your portfolio to maintain diversification and align with your financial goals and risk tolerance. In the next step, we'll explore strategies for monitoring and adjusting your investment portfolio to stay on track with your financial objectives. Start investing as soon as you're ready. Investing early allows your money more time to grow through compounding returns. Regularly monitor your portfolio to track performance and make informed decisions. Look at key metrics such as overall return, individual asset performance, and portfolio diversification. Rebalancing your portfolio periodically is crucial. This involves adjusting your asset allocation to maintain your desired risk level and align with your financial goals. For example, if one asset class has performed exceptionally well, rebalancing may involve selling some of that asset to redistribute funds into underperforming areas or those more aligned with your strategy. In the next step, we'll delve into strategies for evaluating investment opportunities and understanding market trends. Investing is a lifelong learning process. Stay informed about market trends, economic indicators, and investment strategies. Read books written by renowned investors and financial experts. These can provide valuable insights and deepen your understanding of different investment approaches. Some classic recommendations include The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel. Take online courses to enhance your knowledge. Many platforms offer comprehensive courses on investing, covering topics from the basics to advanced strategies. Websites like Coursera, Udemy, and Khan Academy have excellent resources. Engage with financial news regularly. Stay updated with current events and how they impact the markets. Understanding the economic landscape helps you make informed investment decisions. Consider seeking advice from financial advisors. They can provide personalized guidance tailored to your financial goals and risk tolerance. Remember, continuous learning helps you adapt to changing market conditions and improves your investment decisions over time. Congratulations on taking the first step towards investing. Remember, investing is about patience, discipline, and continuous learning. Don't be discouraged by market fluctuations or short-term losses. Stay focused on your long-term goals and stick to your investment strategy. As you continue on your investing journey, always keep learning and adapting. The financial world is dynamic, and staying informed will help you make better decisions and maximize your returns. Start your investing journey today and watch your wealth grow over time. Every small step you take now can lead to significant financial rewards in the future. If you found this video helpful, please like, subscribe, and hit the notification bell for more financial tips. And that's all for today's video. I hope you enjoyed it and found it helpful. Remember, we have new videos every Tuesday, Thursday, and Saturday, so don't forget to subscribe and hit the notification bell so you don't miss any. Let me know in the comments what topics you'd like me to cover in future videos. Your feedback is really important to me. Thanks for joining me on this financial journey, and I'll see you in the next video. Thanks for watching, and happy investing!